good morning. You're watching the market right here in ET now, and a little disappointment considering we were counting in on a life high, but that seems to be eluding us at least for a short while now. The equities managed to close in the red after 2 days of an upside that we saw. Of course, it's the US debt ceiling which kept investors on bay. Having said that, FIs continue to pour in money into India equities, and they've been now buyers for a 14th straight session. Yesterday as well, it was a buy quantum. It was financials and autos which actually weighed down in the Nifty, and even the Nifty bank, it eluded to make a hit at that all-time high once again. And this morning again, it's a little bit of a tempered move across global markets as well. So you don't have any much enthusiasm play out by way of a global handover, or for that matter, how the SGX print as well is moving right now, which Nikunj once again is indicating a slight bit of soft start for us.
There was this weekly expiry in Bank Nifty that I think also added to the volatility. Look, the contours which have been driving the market, they are still intact. I'm just going to exactly repeat what I said yesterday. The contours which are driving the market: number one, big reversal in FII flows. Second, participation which has just about started coming back in mid and small cap stocks. Third, decline in global inflation, and the fact that the earnings season this time around has been more than satisfactory. These are the three pillars on which markets are moving higher. Those pillars are still intact. So flows are decent, DI and FI. Liquidity is coming back into mid and small cap stocks. And globally, whether it is risk on or perhaps a contra trade because of decline in dollar index, I think that trade in a sense is powering global equity markets ahead. So the factors are intact, and if the factors are intact, I guess the trend is also going to remain intact. Within that large trend, which I'm calling it as the summer rally of 2023, you will have a couple of volatile days, few choppy days, but that's par for the course. That's how markets they move. Last week also we had one bad day, one flat day, and 3 good days. This week we've had one bad day, we've had one good day, one flat day. It could be another flat day.
Yep, it absolutely could, because overseas this time around, the kind of cues that we've got, well, most of the major indices on Wall Street ended lower. The Dow down by close to 1% as those debt ceiling talks are still awaited. You've also got the Asian markets, which is looking quite choppy, and the European markets wrapped up the day in the red. You've also got gold hovering around that 2,000 mark per ounce ahead of these talks, and the SGX Nifty as well pointing towards a slightly tempered start. As we did allude to, the FIIs continue to remain net buyers, 16,370 crores so far this month, so 14 straight days on the trot that they have remained buyers. But at the same time, or in the same breath, you've got the demat account additions, which has been quite contrary, and Nikunj at a 9-month low, with the April SIPs flows at a 2-month low. What is this indicative of?
I think it's told, everyone's talking about it, so that's the reason we're discussing it right at the top of the show. What do we have? We have a marginal decline in SIPs, and I don't know why everybody is making it's actually you're trying to make a, mole out of a mountain. And that actually is slightly unfair, because there is a seasonality which would always be at play when it comes to the SIP flows, and there is going to be a year-end effect which would be there. Now, demat accounts, I think this is a function of two things, because 2022 and 2023 have not been great years. A lot of work from home crowd has moved back to, travel has normalized. So a lot of that bulge what you saw in that demat addition was also a function of strong market and work from home crowd. Things have started normalizing. Markets are no longer, or markets at least in last 6 months have not given you excellent returns. So a lot of data what we are analyzing, I think, would be a function of how markets have been rather than a future indicator. But at some point in time, you must also realize that the base effect would kick in. But the red flag here is that if mutual funds, they continue to underperform their respective indices, which large part of the mutual funds have done, I guess the SIP flows will be challenged. If equity market conditions do not improve in next 3 to 6 months, because we only had one good month, I guess there would be a decline in demat accounts. So it is not like Indians are saying goodbye to equity as an asset class, but yes, the moments of sugar rush and this entire linear surge what we saw in demat as well as SIP, I think that could be challenged.
Yeah, but the FII buying continues, so at least that one comfort factor is still there.
Aisha, I think they've just come back.
Yeah.
You look at the numbers. We were looking at numbers yesterday. For 2022, the number was about 1,60,000 crore net sell. The number this year so far is about 30,000 crore.
Yeah.
I'm just making a point that what if by the end of the year, this year, by 2023, if the flow they reverse. So we could be looking at $3 to $4 billion of additional inflows coming back into equity because they have to normalize their India allocation. The money which went into China by force will come back into India because China has got their own issues. China may be cheap, but it deserves to be cheap. India is expensive, but it deserves to be expensive. India is the performing market. India is the performing country. India is the market where earnings are strong and the stability of the banking system is solid. All that factors put together, FI has been forced to make a comeback. Look at what the narrative. I mean, I'll give you this simple example. The US bond yield yesterday shot up, which means the US markets or US bond markets are telling you that the inflation fear is not over for their economy.
Yeah.
Look at our inflation. We are at 18-month low, and Reserve Bank of India has done a great job in really, slaving the dragon, so to speak. So my limited point is that there are two dynamics which are at play. US struggling with growth and inflation. India, where inflation is under control and growth is strong.
Yep, absolutely. Okay, let's get in some more global opinion then. And okay, here's first Ashwini Agarwal from Demeter Advisors. He's fairly positive on banks as a sector and believes that a compression in NIMs will be offset by credit growth going forward.
If you look at the bank sector results that have come out for the March quarter, and you look at the commentary from the banks, they're all talking about very solid credit growth. Yes, there will be some compression in NIMs for sure, because deposits are not growing that fast. But at the end of the day, growth is important, because that is a indicator of what the underlying economy is doing. I'm also reasonably constructive on the banks, where I think the commentary has been more about the worry about slowdown in NIMs. And I think a compression in NIMs, not slowdown, compression, a compression in NIMs will be offset by credit growth. That's my take. So overall, I don't see earnings disappointing even for the banks over the next year. And the stocks have not done much post the results, post very, very good results, for example. So I think that would be an area where I would continue to be reasonably constructive.
All right, let's get a move on and get in a global view then. And Anisha joins in to give us a take as to what some of the prominent voices in the US House are saying, as well as, of course, Elon Musk.
Well, absolutely. But let me start with the thing which is most talked about globally, and that's the U.S. debt ceiling limit. Remember, the U.S. President Joe Biden had to cut short his G7 meeting to meet with the congressional leaders. And now we have the latest commentary coming in after that meeting, wherein the House of Representatives Speaker said that the two sides remain far apart on the agreement to lift the debt ceiling. But he said it is possible to get a deal by the end of the week. It's not that difficult to reach an agreement, but for now, the two parties are really far apart. Moving on and talking about what the latest commentary coming in from some of the Fed members. Richmond Federal Reserve member says that he likes the optionality that was implied by the Federal Reserve Bank last time when they discussed the rate decision. But they believe that going forward, he's comfortable with raising interest rates further because inflation has still remained sticky, and that's the key focus area. Similar commentary pretty much coming in from Ms. Mester as well, who's another Fed member. She said that US Central Bank is at a point yet where they can't hold the interest rate steady, and given the fact that inflation has been stubborn, it might need further rate increases. So hawkish commentary coming in from a couple of these Fed members. Shifting focus to what Elon Musk has to say, and this is again coming in with respect to the Fed decision. He said that Fed was slow to hike the rates, and now they're going to be slow reducing the rates as well, and the economy is going to suffer as a result of that. He's been quite vocal about it, so reiterating his view. And lastly, wanted to wrap up with the comments coming in from the Bank of America Fund Survey, wherein they talk about how the sentiment among fund managers had deteriorated to the most bearish in the year. 65% of the respondents believe that they're expecting a weaker economy. That's why they have moved a bit more into cash, and the positioning is also a bit more defensive.
Sure, thanks a lot for that. Now, when the Fed members are sounding hawkish, watch what happens to the 10-year paper. And this higher for longer narrative, is it really making a comeback? That's the Nifty for you. Let's look at the US 10-year paper, which shot up. The dollar index is at 102.5. So there are two things here. The dollar is inching higher, and the US 10-year paper now has gone to 3.5%. But Indian markets, well, they are in a different orbit, so to speak, and they deserve to be in that kind of an orbit, because what's happening in the world will impact us, but what's happening in the world is not going to influence us completely and totally. Gone are the days where US would sneeze and everybody else would catch a flu. No, that's not happening. We are no longer joint at the hip, so to speak, when it comes to some of these global linkages. Our monetary policy, our GDP growth, our forex reserve, everything is moving independently of what is happening, at least in the developed markets. Kunal, the bulls had a day off. Could it be a couple of day offs now, like 2-3 days off chutti?
Yeah, it could be. I think we've already spent 6 days or 7 days in this range, 18,050 and 18,350 or 400. So it doesn't, surprise me that we may spend another couple of days. In fact, most of the stocks, in fact, this was a pattern which I highlighted yesterday as well, that most of the stocks which have rallied up 20%, 30%, whether it's the large cap names or the tier to large cap stocks, these stocks have had a tendency of, giving a breakout, spending almost 8-10 days into a consolidation and then breaking out, whether it's the likes of Bajaj Autos, L&T, which had given a breakout earlier, Siemens, then you have Oro Pharma. Most of the other stocks have given such kind of a price pattern for themselves. So I would expect something similar to happen for the Nifty. And in fact, if it comes down to the lower end of the support range, it actually would be a good risk reward to maybe add on to the existing positions for the indices. No change in terms of the open interest on the Nifty. So I think just 0.07% change on the Nifty open interest data yesterday. That also indicates that even if the indices were down 100 odd points yesterday, there was no major effect in terms of unwinding or building of shorts for the index. So the view remains neutral to positive on the indices, and expecting that if we come back to the lower end of the range, 18,050 approximately, that could be a classic re-entry point.
Right. Nooresh, hi, morning. While the index may consolidate, you think the bank Nifty will make up for it, or is that also gone into consolidation mode?
So the bank Nifty should continue to consolidate just the same way like the markets are. The case here is because if we look at the bank Nifty, the largest contribution comes from HDFC Bank. That's a stock which has gone into a sideways consolidation, and it's tough for it to cross that 1730, 1750 mark or break the 1550, 1600 mark. So that moves out a major, say, a trending move in the bank Nifty, because the rest of the names have lower contribution. So then again, after that, Kotak Mahindra Bank also is in a sideways zone. So overall, Bank Nifty could slowly and steadily move up. It could see a trending move, a quicker move once HDFC Bank also takes charge. So for now, it's a buy on dips for the same reason that dips to 43,700, 800 continue to be a buy on Bank Nifty, and overall we go slowly and steadily up.
All right, let's find out those stock-specific trades. What is it that our chartists are betting on this Wednesday morning? And Kunal, what makes it to your list?
So GNFC is the first stock which looks attractive, consistent breakout for the stock, breaking past, and in fact the indicators have not yet entered into the overbought territory, so that could be a relief that maybe there could be some headroom left for the stock before it reaches the overbought territories on the short-term chart. 675 is a target for the stock over the near term, stop loss at 630. And the second would be Aban Devyani International. Even this stock has shown a very good recovery, a classic, I think 30% to 40% recovery in the last 1.5 odd months, and the momentum seems to be still quite strong as well as consistent. So buy with a target of 196, stop loss at 180.
Okay, there you have it, two mid-cap recommendations. And meantime, Nooresh, what are your buy calls?
So first is a buy on Coal India. Continue to maintain the bullish stance. Yesterday, the stock broke out above the 240 mark, closed well above 240. That's a new 52-week high, not far, almost at a new all-time high on a dividend-adjusted basis. The stock has given a short-term breakout. Expecting this to continue towards 260 in the short term, a stop loss at 234. Second is a buy on Tata Power, which has gone through a 1.5-year period of consolidation. After that huge move from 60 to 250 plus in 2020-21, the stock has been in a sideways to a downward drift. 200 was the 200 to 190 was the support level. We broke below that, and now we've recovered back. Also came very close to a 3-month high yesterday around that 212 to 15 mark. Good volumes. That's possibly an indication of a trend change going forward, and seeing a recovery all the way to 230, 250 levels. So preempting that breakout, keeping a stop loss at 205.
Okay, those are a couple of stock ideas coming our way, but let's address what the FII flows are suggesting. In fact, we have with us Seth Freeman joining in right now to talk about what he's making of fund flows as of now. Seth, hi, good morning. Great to have you today on ET Now. Let's first address India, right? And we've been seeing consistent buying for the last 14 sessions. In fact, quantum almost half of the last time FIIs poured in money into India equities. Just wanted to understand what you think is working in India's favor right now as opposed to the rest of the world.
Well, I appreciated some of the comments earlier about somewhat of a disconnect that India has recently achieved. But it reminds me of problems going back to the 2000s when there was tremendous discrepancy between FII flows and domestic investment. And one of the things that happens is it creates a lot of volatility because you can have the market jarred by just as rapid outflows as inflows. Now, with SIPs and so forth over the last decade and a half, it's become much more stabilized. But it is concerning to me. India is getting a lot of positive press globally. There was also serious political problems, at least from a U.S. expansion standpoint, into China. And so I think India is a recipient of that.
Seth, morning. Given the fact that, yes, indeed, the FIIs have remained on a buying spree, but there are going to be a lot of factors as well down the line. You've got the monsoon, the elections, etc. Do you believe that this will largely influence the liquidity flow, or do you believe that it will continue to remain consistent buying?
No, I think you're going to see some consistent buying. I don't think that investors are really focused so much on these near-term domestic concerns because, in general, Indian companies are growing more rapidly than U.S. companies. And we're looking at a, recession. We're definitely looking into a recession here. How severe it's going to be is another story. But, there's still, major allocations to emerging markets. The one thing that happens, though, is as U.S. rates rise, the dollar becomes stronger, and emerging markets currencies, including India, can suffer because of that, and so that is a risk for foreign investors.
The other concern also is more near-term, right, Seth? I mean, the June 1st deadline for the debt ceiling, and I guess that also is going to impact flows out of the US and perhaps to other EM economies like India.
That's a little more optimistic than I think. Maybe flows out of treasuries and ironically into banks temporarily, but I don't know that money is going to really shift into India as a hedge against a prospective U.S. default. And I personally believe that's a very low risk situation, that we've seen this brinkmanship between the political parties here. It seems like almost every time we need to raise the debt ceiling. And I think once the rhetoric and the finger pointing and everything else starts to fade away, we have to have a deal here. It would be an absolute shock if the debt ceiling's not raised.
And what's the expectation in terms of valuation-wise as well, how India is looking currently? And have you seen some sort of a shift from the other emerging markets pouring into India now?
Well, again, the economies that have been dependent on consumption from China, those are gonna suffer. The overall real estate economy globally is suffering from just higher interest rates, and so I do think I've been on the same mantra for nearly 20 years now about the long-term prospects of India, and so much has happened, and there's still so much room to go.
Now I want to switch back, Seth, to what the Fed action is. And now you have a critique even in Elon Musk, right? This morning he's saying that his biggest concern is that Federal Reserve has been acting upon stale data. They were behind the curve in raising interest rates, and they're going to be slow at decreasing them as well. Just wanted to understand, with all the talk about recession, which, like you said, seems inevitable, what is really, you think, the Fed Reserve action going to be like?
Just as a fundamental issue, I tend not to agree too much with anything Elon Musk says. He's a very successful car manufacturer, but maybe he should stick with that. I don't know about his economic and Fed prediction and economic policy statements. But clearly, we had a long period of very low interest rates, and this has affected especially the U.S. Housing market. The low interest rates allowed house prices to inflate incredibly. And now that we have mortgage rates that have gone from basically 3.2 or 3.5% to 6.5 and 7%, that radically changes the real estate market. The Fed is going to be slow in reducing rates. We have a strange problem in that they are trying to slow the economy. They're also looking at employment figures, and we happen to have, increased interest rates, but we also have a relatively high level of employment. So it seems a little crazy from a policy standpoint to create an environment that is intended to increase unemployment or has an effect of increasing unemployment in order to mellow out the economy and mellow out inflation. So it's definitely going to be a challenge.
All right, good to have you on board, Seth, putting all of those data points into perspective. Definitely, getting a take from you as to what you make of those comments coming in from Elon Musk, as well as, of course, the liquidity situation back home. Time for a very quick break. Be right back.
Okay, back with the market right here in ET now. After 2 days of red, you are seeing the SGX Nifty again looking at a bit of a tempered start for us. Yesterday, of course, we managed to close in at the session lows after what looked like an extremely range trade. Having said that, we've not fallen a whole lot. But yes, from that 18,400 print, it's a bit of a step back for sure. We've now been standing under the 18,300 level. A lot of earnings to digest still, and let's take it across to Somit, find out firstly how Bharti fared in the fourth quarter. Somit?
Well, if you see in the fourth quarter, it's a marginally weak set of numbers reported by Bharti Airtel, and the miss was largely led by the India mobile business. If you see the India mobile business revenue growth, that was the slowest in the last 10 quarters, while the EBITDA growth was the slowest in the last 13 quarters. And this miss was on account of the fact that the ARPU number was lower than what the street was expecting. Street was expecting the ARPU to come in at around 196 rupees, but the company reported a flat ARPU of only 193 rupees. Now, if you see in the fourth quarter, the company had increased the minimum recharge plans, and despite this, the ARPU number has come in flat at 193, and that's the only disappointing factor for Bharti Airtel numbers, because of which the India mobile business was on the weaker side. However, on the positive side, if you see the company's DTH home broadband and enterprise segment reported numbers which were pretty much in line with what the street was expecting. The 4G subscriber addition pace was better than the previous quarter. The net debt also came down by around 2,200 crore rupees, and this is despite 5G rollout and 4G expansion in rural areas. Also, the company's churn rate dipped to around 2.8% versus 3% that we had seen in the previous few quarters. However, when compared with the Reliance Jio numbers, Airtel numbers were much on the weaker side. If you see, the Reliance Jio reported a much better revenue, EBITDA and ARPU growth as compared to that of Bharti Airtel. Also, the data traffic and voice traffic growth in Reliance Jio's network was much ahead of what Airtel has reported. Now, Airtel saw a data traffic growth of only 3%, while that of Jio increased by around 4.5%. This is because of more 5G subscribers coming on board on Jio's network. So this is what Airtel numbers were, marginally on the weaker side, primarily led by lower than expected ARPU.
All right, thanks very much. We'll be watching out for Bharti Airtel in today's trade. Moving right on, other stocks in news, an upbeat commentary from Axis Bank and Canfin Homes that their management meets. Let's find out what the key takeaways were, and Harsh, my colleague, joins in with all those details. Harsh?
Well, yes, Avan. So Jeffries met up with Axis Bank, and what Axis Bank continues to suggest is that the Citi integration is progressing well, and Jeffries seems to validate that. They also believe that the Citi business is going to be ROE accretive from FY25 onwards. Management continues to, with respect to loan growth, continues to maintain a robust estimate of that loan growth number, 18%, and they are expecting ROEs to trend in that direction as well. NIMs, they believe, will moderate going forward. They don't need a capital raise right now. That's largely the management commentary as well, and they believe that there's going to be big progress on the digital platforms front. They want to become the #1 mobile app in the world, and they're focusing on improving deposit mix over the next year or two. That's the other piece. Asset quality continues to remain stable. On the ECL front, Axis continues to maintain that the impact of the transition will be negligible or nothing major. With regard to Canfin, they believe, or rather they met up with Phillip Capital. They believe that growth is largely going to be driven by inflation as well as higher productivity. They are maintaining a growth guidance of 18 to 20% with regard to disbursements as well as AUM in FY24 full year. They are expecting competition to likely be benign, with balance transfers at lower levels than during pre-COVID. They're expecting credit costs and OPEX to remain benign as well in FY24, positive on that front as well. And they're expecting that with a favorable borrowing mix and pricing spreads, largely they expect a stable set in FY24 as well.
Okay, Harsh, we'll leave it at that. In the meantime, let's take it across to Vamakshi, find out what LIC Housing reported in its fourth quarter performance.
Well, yes, a strong set of numbers have come in for LIC Housing Finance. When we look at the net interest income and the net profit, that has come in much higher than what analysts were expecting. Even the asset quality has actually improved. Now, let's look at all these numbers in a little more detail. Net interest income stands at 1,990 crores, an uptick of almost 22% coming in on a year-on-year basis. In fact, the calculated NIMs as per CLSA are at 2.9%, and this, in fact, is the highest that the company has seen in the last 24 quarters. Provisions at 307 crores are down nearly 60% on a sequential basis. So overall, driven by a healthy NII growth, a decline in cost to income ratio as well as lower credit costs, net profit stands at 1,180 crores, an uptick of almost 6% that has come in on a year-on-year basis. Asset quality has also improved sequentially from 4.76% to 4.41% as far as the GNPA is concerned on a sequential basis. Now, when we look at the company's valuations as well, the industry average is at around 1.8 times, but LIC Housing Finance valuation is at 0.9 times. So compared to the industry, the stock is actually trading at a discount. Now, apart from that, we also had a few brokerage notes that came in. Now, most of these brokerages are appearing to be quite positive on the numbers. CLSA and Jeffries has maintained its buy rating, whereas CLSA has in fact hiked their target price from 520 to 550 per share. Brokerages are highlighting that this is a big beat that has come in after two consecutive quarters of miss, and in fact we will be watching out for the management commentary that will come in as far as the movement in loans is concerned as well as the borrowing costs.
Mr. DS Pai joins us now. Let's understand from him that if there is a 4-day delay in the onset of monsoon, is this the first red sign or this is something which could be ignored? Good morning, Mr. Pai. Thank you for joining us. 4-day delay in Kerala. What should we think? What should we assume?
See, actually, Kerala monsoon onset date has got around 5 days of standard deviation. In that respect, delay of 4 days are within the normal range. So we cannot take it as a big delay, because we have seen that last several years, monsoon has been, slightly, in mostly, for example, last 3 or 4 years, monsoon is coming very close to normal days. Only certain years that has given a long delay, particularly during the El Nino years time. This year, in spite of El Nino expected, the conditions evolving within the Indo-Pacific regions are indicating that in the next 2 or 3 days, the cross equatorial flow will, will set up in the easternmost Indian Ocean, North Indian Ocean, and slowly we are expecting next within 2 or 3 days, monsoon to reach our South Andaman Sea and Nicobar Islands. So in that respect, till that area, it is coming close to normal. However, models are indicating that over Kerala, there can be slight, delayed than normal onset, that is 1st June.
That seems pretty okay, Mr. Pai, considering it's only a 3-day delay. But tell me, is it too soon to predict how the geographical spread of monsoon is going to be? How long before it hits Maharashtra here? It's so unbearably hot.
Yeah, in fact, we should be lucky this year. Heat waves has been subdued. Okay, so though Maharashtra and all temperatures are very close to 40. Last 15 days or almost 1 month, the heat wave condition had been subdued. Even still now, you will see heat wave conditions are only over coastal Andhra Pradesh and particularly northwest India in neighboring central India. Maximum temperatures are around 1 degree less than normal. So, however, we are expecting next 2 or 3 days the temperatures to increase by 1 to 2 degree over this region. So though we are not expecting very soon heat waves, and to your question that about monsoon onset distribution, the normal monsoon onset which we had prepared last 2 years back, actually it is indicating that in recent years, after though monsoon onset over Kerala coming, its normal date is close to June 1st, the other part, it is a much slower than earlier, actually. So our Maharashtra and other thing, only after June 10th, we were a normal date. So this year, since we are expecting over Kerala itself with a delay of 3 days, a similar delay we should expect over Maharashtra also.
Okay. Mr. Pai, there seems to be a big change in terms of IMD's view. For example, when we had extraordinary higher temperatures in the month of Feb, it appeared that we could be in for a year of a very strong summer and the El Nino impact. But looks like those fears are getting addressed. It's looking much better than what it appeared, let's say, in the month of March and April.
Yeah, you are correct actually. So that time monsoon, most of the model forecasts were indicating very large number of heat waves. But we may still can experience heat waves during in the late May and early June, because as we are saying, monsoon will be slightly 2 or 3 days delayed over Kerala, and already the normal monsoon onset are dates are slightly less delayed than earlier. So we can expect still heat waves in the month of June, early June, in the first half of the June.
So what is it, Mr. Pai, that you're penciling in terms of the model forecast, and any outlook in terms of as well the quantity of rainfall this season?
See, already we had issued a forecast in the month of April, that is 96% of with a model error of plus or minus 5%, which is coming in the lower limit of the normal monsoon criteria. And we will very soon, by this month end, we will come up with an update for this forecast. So as per the April forecast, you might have seen that we are expecting below normal rainfall are most likely over central, in the northwest India and neighboring central India, and above normal to normal rainfall over southern peninsula and northeast India. So however, as now that El Nino has become more reality, all models are indicating that. By taking into account that, and also a possible positive IOD in the monsoon season, and that we have seen below normal snow cover over Eurasia. By taking into account all that, we will come up with a forecast in the late this month.
Okay, my final question is that it's not for the first time the onset of monsoon has been delayed. But when the onset of the monsoons have been delayed, and if you can just enumerate this with examples, what has been the average rainfall that year? And if the monsoon gets delayed, what are the chances that it could pick up as it progresses?
See, there is no relationship between monsoon onset date that reaching over Kerala and total rainfall over the country. Okay, so for example, 1997, in fact, monsoon had come almost 1 week delayed, and it was also strong El Nino of the century. Still, monsoon rainfall was 102%. That is 2% above normal. Okay, so as such, we have seen that there is no relationship between the arrival of monsoon over Kerala and the total rainfall, mainly because after once it comes over Kerala or after reaching peninsula, it can go very fast over central India and northwest India. In fact, the normal onset date which we had published in the last 2 years back, the total date at which a country is covered by monsoon is now 8th July, where was some earlier it used to be normal date was 15th July. So from central India to northwest India, generally now we are expecting the progress of monsoon is much faster. So in that respect, we don't, even though there can be 3 or 4 days delay over Kerala, we don't expect delay over central India. Still, you have to watch for our forecast which are given or update which are given day to day for taking any decision.
All right, Mr. Pai, couldn't have heard a more positive news than this. Don't worry about that delay. It's just merely 3 days. Heat wave has been subdued so far in the country, and Maharashtra should see the monsoon hit our coast by, say, 14th of June. That seems to be the indication. But Mr. Pai, great speaking with you today. Thank you so much.
Thank you.
Let's move on and let's talk about what the market setup is looking like, what could be the actively traded stocks and what could not. Hemang Jani joins in on the show right now. Hemang, hi, morning. Good to have you on the show as always. Help us understand how you're analyzing BOB's performance. And many in the market believe that with this quarter, NIMs for banks should be peaking out. Would that be a concern, you think?
Good morning, Aisha. I think BOB numbers were operationally in line, and we feel that overall PSU banks as a space has done pretty well operationally. And though there were in between concerns about this expected loss provision, we think that it is a little too early to really react to that. So I think when you see a strong earnings growth, let's say at pre-provisioning level, the growth is almost about 43%. Asset quality has improved. And when you look at the other parameters like return on assets, etc., there is a significant improvement. So I definitely think that the earnings cycle is still very strong. And though we can always debate about the NIMs, having peaked out, but as long as you see strong earnings growth and the valuation comfort with ROA, I don't think we need to be negative on the sector per se. So we continue to be very positive on BOB.
Okay, let's get a move on then and find out what the stocks are on the editor's radar today. Let's begin by discussing diagnostic stocks then. And it's interesting because we've mapped out the data when it comes to the valuations as well as the revenue growth pre-COVID as well as what they are at the peak levels and currently. And Nikunj, what's the diagnosis?
No, I guess the prescription was not looking great.
Oh.
But I think now things have started improving for an investor. See, this is how things really moved for the entire diagnostic space. In the green is pre-COVID. Then you had the impact during the COVID peak, and now what the current market valuations are. So if you frankly ask me, some of the valuations for some of the diagnostic stocks, they'd become sky high in COVID.
During COVID, yeah.
They reached to P multiples of 100 times, 70 times, and that is not going to be sustaining for a business which is growing at about 10 to 12% to 12 to 15% depending on the company you're talking about. So there was an extreme greed and a euphoria during the COVID time. But after that, there is the realization which has kicked in that look, these are not extraordinary businesses. They went through an extraordinary, they enjoyed an extraordinary tailwind. But these businesses now, these companies are still growing. The need for better healthcare, the need for early diagnostics, this entire market is gaining, the listed players are gaining more market share. There's a massive consolidation which has already happened in the industry. So from euphoria to now fear, I guess now it's time to start buying into some of these diagnostic stocks. They generate a lot of cash. These are high return ratio companies. Markets have completely written them off. They have presence in the F&O market. They are using technology and AI. We're forgetting that how technology and productivity in some of these functions is actually improving. So I will not be surprised that after this real massive decline what some of these stocks have seen, Metropolis is down 25% from its 52-week high, Dr. Lal is down, it's actually flat, but from the top it's down by about 50%. Some of these stocks can actually give you a positive returns or a double-digit returns from here to, let's say, year end.
Okay, that's the prescription on the diagnostic stocks, but let's shift gears and talk about IOC in particular, a result candidate, and interesting because their quarterly profit came in at a 10-year high, and even analysts believe that some of the issues when it comes to are looking pretty transitory in nature, and there's been a beat led by refining.
I guess the refining margins have surprised everybody, and the fact that refining margins have gone up by $2.4 and they are at $7.1 for a quarter gone by, I think was extraordinary. Two things which I think are happening now. One, the windfall tax which was there on diesel exports, that's over, which means government is okay if these companies are making money via exports and by refining. Second, at the retail level, oil marketing companies are now making money. We spoke to the chairman of HPCL. He did say that, look, it's looking good for us. And looking at the fact that this time around, even before Karnataka election, the fuel rates were not down. That means that the government is committed to really help these companies make money. Unlike last year where they were arm twisted or they were forced not to take a price hike because government had to bring inflation down. This time around fuel prices are down or crude prices are down, rupee is stable, yet there is no price cut, which means on a retail level, when they're selling diesel, petrol, both industrial and retail, they're making money. So GRMs are strong, stocks have underperformed, currency is stable, crude is down, and then they're making money in the marketing margins, which is the basic bread and butter business for them. It's an ignored sector. Avan, FIs don't buy this, but domestic institutional investors, I think it's a matter of time, will take notice of the fact that there is deep value in these stocks.
And IOC already delivering on that front. So Aisha, interesting take there with stocks on the editor's radar.
Oh yeah, absolutely. In fact, let's add one more, and that came out with its numbers, Bharti. Hemang, you have a view here, right, on the reduction in the free cash flows despite the 27% jump in EBITDA that they've actually posted in this particular quarter. What does it really spell for how the stock is going to pan out from here?
Yeah, so Bharti numbers we feel were quite okay. The revenue growth was in line, barely about 1% growth. But the big concern that we see is that there is a significant decline in the free cash flow, almost about 7 billion from 48 billion that they reported 3 to 4 quarters back. The capex is really, growing too aggressively. So my take is that, unless you see a significant improvement in the ARPU, which looks unlikely, the stock can actually go through a correction of about 8 to 10%. Given that it has remained quite stable for many months now. So we do expect some negative reaction on Bharti post these numbers.
Okay, that's the take coming in on Bharti. Yesterday you saw a bit of attraction really in a couple of the mid-cap IT names, led of course by Birlasoft after its earnings. 6% higher is where that stock shut shop. Hemang, recommending at all to start nibbling in at least within IT, maybe mid-caps only?
Yes, surely. I think mid-caps have done much better when it comes to the, this quarter. And even when we look at the stock prices, they are doing much better than some of the large cap names. So I think within the mid-cap universe, we like Cyient, which reported almost about 7 to 8% kind of a quarter-on-quarter growth. Apart from that, we think that Persistent also a very decent set of numbers, and Zensar, which is a very small cap company, again the revenue growth was not that good, but big positive surprise on the margin front and outlook front. So we do think that the mid cap IT is the space where you will see a good traction. Even if we see a little bit of correction or consolidation, some of these names can present a good opportunity to enter with a 15-20% kind of an upside.
Okay. Just scanning through lots of stocks, and one breakout stock yesterday was Mazgaon Shipyard or Mazgaon Dock. Nooresh, just when we thought that the defense stocks are losing their mojo, Mazgaon Dockyard just comes back and goes up 7% higher yesterday.
So a lot of these names only went through a sideways correction, a little bit of a dip, and then were consolidating for quite some time. And we are seeing the next leg of the move play out. We saw a correction from 950 odd levels in Mazgaon to 650. It was a slower drift compared to the fact that it had gone up almost 3x from 300 levels. Now, yesterday, and the more interesting part is not just the price action, but the volumes are almost 5 to 7x the normal volumes. So the recovery from 650 to 800 last time was on lower volumes. This is the first indication of sharp volumes. And we are seeing this across the board. So a GRSE is another one which looks interesting. That stock has gone through a nice sideways consolidation. 540 is a resistance. It's been a range of 410 to 540. That's a stock that can break out in this segment. And then we are seeing that, say, Bharat Electronics has finally come back to 108. The all-time highs are 110 to 115. Bharat Dynamics is on verge of a breakout into new 52-week highs. Yesterday, HL made a new 52-week high. So clearly, defense continues to be a sector which looks interesting, more so from the PSE side. Even smaller names are doing well, whether it is Avantel, Zen Technologies, or Dynamatic Tech. So the sector still is in a strong hands. And we are seeing this across the board in defense names, whether it is large cap or micro caps.
Defense, that continues to be a running theme. In fact, this at a time when mutual funds as well are launching specific defense-focused portfolios as well. Hemang, opportunity to buy a fresh share considering this is a long-haul story?
Yeah, I do think so. Apart from the fact that the numbers have been good and the government is going too aggressive in terms of, giving out orders, some of these names do get included in the MSCI, small cap indices. And because of the, small cap nature and the liquidity issues, sometimes this kind of flows can also have a bigger impact on the prices. So we do think that HAL, Bharat Electronics, Bharat Dynamics, I think these are some of the names where you can expect, a good momentum, 10-15% kind of an opportunity. The only thing is that sometimes it goes out of flavor. So, one should try to really time it with some technicals so that you can really take advantage of the opportunity.
Right. Okay, let's just pause here and let's get you some more fundamental stock ideas. Here's Pankaj Pandey and Deepan Mehta telling us what they recommend buying in this market.
Darren, US revenues were a beat compared to our estimates. Even last quarter, revenue growth for US was quite good. I think India business is yet to sort of pick up, but while Europe is sort of also done well. But our sense is that the company has been focusing more on domestic business, which is contributing about high single-digit kind of a contribution to top line. And going forward with the perspective that domestic business will contribute more and which is a relatively less volatile business, our sense is that Dr. Reddy going forward should ideally do well. We had a previously buy rating. I think we'll again sort of review the numbers, and largely our sense is that things remain intact in terms of what our thought process is. So we'll continue to maintain a positive stance on that company. I think on Sanofi, the challenge with Sanofi is that their growth numbers are quite muted. I mean, 3-4% kind of a growth is quite muted, and even the demerger also may not really do much, because when you look at some of their top brands, so those are still sort of giving a flattish or a negative kind of a growth. So, so from that perspective, unless the growth does not revive, I think demerger may not really help much. We had a previously hold rating on the stock. I don't think, given the numbers, we would need to sort of change the stance there.
I think Cummins is in a very interesting space. We have been very positive on the entire engineering capital goods space, and Cummins, I think, is one of the leading engineering companies. I think it's gensets and diesel engines. Diesel gensets are absolutely world class, and of course, they have the advantage of exporting to other Cummins subsidiaries as well on a transfer pricing basis. Valuations are reasonable compared to historically what the stock has traded at. And I think after many quarters of sideways to slightly disappointing performance, last 2 quarters, at least last quarter and this quarter, may be quite impressive. A lot of the cost increases, I think, have been passed on, and now we are seeing subdued raw material trends, and that should benefit the margin management for the company. And the way we are seeing infrastructure projects take off, I think there's going to be good demand for the company's projects or products as well. So very positive on Cummins per se. And it's a premium player, MNC company, and always has traded at a very high price to earnings multiple. So let's not get too impacted by that. But on the whole, I think next few quarters look very interesting and very positive for Cummins.
And there's one stock which has surprised everybody. It has surprised everybody. Nooresh, you want to guess which is one stock which has surprised everybody and which stock I'll flag off for you? It's a pharma stock. Take a guess.
Tough one.
Very easy one. Aurobindo Pharma. From 300, 380 it has become almost 650. 300 rupees. 300 rupees for a stock in less than 3 months. It's almost like a 50% hike.
So the stock has the tendency to only surprise on both the sides. So it's one of the stocks that is tough to trade. It had this one great cycle in 2013 to 2014-15. Post that, the moves have been crazy every time. So if we go back to COVID, the low was closer to 280, 340 levels. It went back to 1050. And cut to, say, 2 months back, we were back to 400 levels. So there was more than a 60% fall. And now we've seen a recovery of almost 50-60%. So the stock has this tendency. Apart from that, there are days when a single day the stock moves down 10%. So out there, this is a tough call, tough one to trade. And that has been the case with pharma. Very recently, if you look at it, Dr. Reddy's gave a breakout. The stock moved up from 44.50 to 49.50 laboriously over 1.5 months. And all it took was 1.5 days to come back to 44.50 to 4,500. So for now, this indicates pharma as a sector maybe bottoming out or say getting into a phase of consolidation, but it's a tough sector. It is no more a trending sector clearly.
Hemang, morning. What's your outlook when it comes to the entire real estate stocks? Because they really seem to be back in action. Do you believe that it's a very case-by-case story, or are you, sticking your neck out and you remain bullish on the entire theme owing to the capex growth, etc.?
So I think, this is a pocket which has done very well in the last, let's say, about 1.5 months, ever since there was a pause by RBI on the interest rates. When you look at the quarterly numbers, the outlook, it continues to be very strong. And our take is that this cycle could turn out to be very strong for next at least 2 to 3 years. And, this being a high beta space, sometimes the stocks go through big corrections, 30-40%. So I think even when they've gone up, let's say about 10-15%, we do see a scope for a significant, rally in these names. Godrej Property is something that we like. I think we can also look at Lodha, which kind of has relatively not done as much compared to some of the other real estate names. Even the new government in Karnataka, we think that, some of the names like Shobha, Brigade, they could do extremely well. So I think this sector is showing a lot of momentum and one should participate with a positive bias.
Okay. We are talking about one simple fact that markets have gone higher, but where is the participation? Indian mutual funds right now, Indian domestic mutual funds right now sitting at record cash levels. The record cash levels means that how much of the total percentage. Now that's the BofA survey. We'll just come back to it. I just want to set context here. The Indian mutual funds right now are sitting on about 5.5% to 6% cash, which means the cash component in most of the mutual funds right now is up by about 60 bips, even though markets have gone higher. Now imagine if you're sitting on that much of cash, you will underperform when markets they go higher. On top of that, there is going to be additional inflows which will come into the markets this month because of SIPs. So if Nifty keeps on going higher, then we could actually be looking at mutual funds cash levels at a relatively higher level. These cash levels of 5%, 6% were last seen during when the war broke out. And that was a very different kind of a geopolitical crisis. But the BofA survey, which is a global survey of fund manager, very famous survey, which is done anonymously, where fund managers, they are encouraged to participate and talk about where they think markets are headed, what is in the price, what kind of cash levels they are in. 61% of the fund managers, the equity fund managers and bond fund managers, they feel that the Fed interest rate cycle has peaked out and the Fed may actually cut rates by 2024. That's what US markets are factoring in. Allocation to stocks is rising. It is at a 5-month high because if interest rates they come down, the allocation to stock will come out. Big rotation out of commodities into tech. Another very interesting. Now this global tech we are talking about, guys. We are not talking about Indian tech here. But the cash levels, according to BofA survey, this is a global survey, the cash levels with some of the funds, I think has still not come down. Why am I bringing this cash level point out again? So that means that at a global level, if allocation is coming back into India, which it is, there's a lot of cash which will automatically come back into India because cash levels have to come down if markets rally. B, in domestic market also, cash levels are high. So markets go high, slip flows, they continue. Domestic institutional investors will be forced to buy. So there is a lot of gunpowder, so to speak, which is there, available with institutional investors to really participate even if markets they go higher. Himangjani, what is the status with HNI investors? I mean, do you think that they've participated in this rally or still there is a lot of left out syndrome?
So Nikunj, with retail investors and HNIs, I think the larger participation is in the broader market, which is mid cap and small cap category. And if you see last 1.5 months, we've seen a very strong up move there. And when we look at the cash volumes, there is a 25-30% kind of improvement that we've seen. And when you see the churn happen, when you see, let's say, a defense stock or some of the pharma stocks, a very good listing by Mankind Pharma, so that lifts the sentiment up. So I think though there is a little bit of a reluctance to enter because of the way the market is run up and the levels. I think given the momentum in the mid cap category, people are participating. And we think that this should continue. I don't see a reason why there is going to be a big correction in the market or the broader market will correct in a big way because results have been good. The interest rate cycle is turning a little better. Global markets, we are not seeing any major shock. So I think that's a good sign for retail participation.
Okay, that's the view coming in. Moving on then, Kunal, wanted to get in your take, and every time I open the email for the breakout shares, I see Birlasoft's name appearing on that list. Just what's going on? Because in the last 1 month, it's beefed up by nearly 25 to 30%. What's the outlook on the charts? And have you also had a look at Mazga or Doc? Because that stock scaled up yesterday.
So I'll start off with Birlasoft. Interesting breakout, 4 consecutive weeks of uptrend for the stock. And I think after yesterday's up move, the stock has convincingly separated or diverged itself from its 200-day moving average. So for the prior 4-5 days, other than yesterday's breakout, the stock was just hanging around the 200-day moving average with a bit of an indecision that whether the stock would probably cave back again into a corrective phase or breakout. But I think after yesterday's move, one thing seems to be clear that the stock is now starting to show signs of uptrend. Now, when you try and compare this with the previous 2021 highs for Birlasoft, the stock is at a significant discount. And the 2021 highs for Birlasoft was almost at 540, 550 levels, and currently the stock is at 320 plus, which means that even if the stock has to come back to those high levels, say in the next 1 or 2 years, the scope of uptrend could be significantly higher for the stock. So I think in that aspect, it could be a good candidate of a buy on dips. Now, on the other hand, Mazga and Dog could be interesting because HAL is actually one of the prime stocks from the defense pack, which has actually given a breakout, I think almost 1 or 2 weeks back, followed by some consistency as well as some up move in BEL. And now the move is trickling back into those mid-cap names back again. So it was not just Mazga and Dog, which did pretty well yesterday. I think GRSC, Garden Reach Shipyards, Cochin Shipyard, many of these other names also started to show signs of a flag pattern as well as a minor swing pattern breakout. So I think it's got to do with the entire sector theme that if the large cap or the more formidable peers from the defense pack, if they start to show signs of consistency of uptrend, breaking past about new highs regularly, then I think it could just be a matter of time that the mid cap and the defense pack could also get a bit more vibrant. So bullish on the entire defense pack. Specifically, HAL would be the top recommendation which I would keep on highlighting.
Okay, consistently bullish on HAL. Moving right on then, let's check in on those pre-open rates. And as of now, it's a bit soft at 18,270 levels on the Nifty. For the Sensex too, we're down about 93 points. Let's find out those mid-cap strategies then. And Nooresh, what's your mid-cap bet?
So that would be a buy on Maharashtra Seamless. Now that's a stock which has finally made another move to life highs or closer to that. It's very close to that levels. But if you look at the sector, the whole sector has been doing well. Whether it is Jindal Saw, Maharashtra Seamless, we are seeing this trend Ratnamani Metals. So this is a stock which has made a new fresh 52-week high and an all-time high. The stock consolidated around this 430-40 resistance for the last 2 weeks and now finally back well above the 440 mark. I would expect this trend to continue for the short term. Expect a move towards 500 to 530 levels. A stop loss to be placed at 425.
Okay, Maharashtra Seamless is what Nooresh's bet is. What about you, Kunal?
So it's from the mid-cap cement pack. Sanghi Industries is a stock which I would suggest as a buy. Classical breakout on the monthly charts. A cup and handle breakout on the monthly line charts for Sanghi Industries. On the daily time frame, it's a flag pattern breakout after I think 3-4 days of consolidation for the stock. So again, interesting chart patterns, and that's why I would believe that the uptrend, both from the near term as well as from a medium term, could be intact. 85 as an immediate target for the stock and stop loss at 70.
Let's get right back to the markets and all the khabar on D Street. Well, we understand that pharma major Glenmark Pharma is in focus. The management has returned after conducting roadshows in the US and across Europe. The company is also set to declare its Q4 earnings on the 19th of May. What exactly did the management guide at these roadshows? We've got Sharad who joins in with all the khabar. Sharad?
Well, yes, in focus we are having Glenmark Pharma, and over here important development coming in is that the management has recently come back from the US and the Europe's road shows for the investors, and they have stated that a strong growth guidance is expected for the margins going ahead, and also there will be a focus on the debt reduction. Now looking at the FY23 guidance numbers, the top line is expected to rise between 6 to 8%, while the margins are expected to be flat by almost 19%. The capex plans for the FY23 is expected to range between 700 to 800 crores. Now there are certain risks associated with the stock as well, and firstly the important thing is that the core US generic business has actually not picked up and is still under pressure, while there are important plants in Baddi and Monroe which are under import alerts. Now apart from this, also the Iconos portfolio and the licensing issue is something to ponder upon. While looking at the stock itself, the board meeting will be there for the earnings on the fourth quarter on May 19. Apart from this, recently the company announced formation of a new arm, Glenmark Healthcare, which will actually manufacture as well as come in trading of a pharma goods, and we spoke with industry participants and they stated that this move could actually aid margins going ahead, as well as cross-selling could be triggered. The stock itself, if you look at it over the last 1 month itself, is up more than 25%.
Okay, that's the view coming in on Glenmark. Thanks very much for that khabar. Hemang, before we let you go, tomorrow ITC will be coming out with its quarterly numbers. What do you think we can expect in terms of the performance?
So I think across all the divisions, there is a very good traction, be it hotels. We all know the occupancy levels and the way the companies have delivered. The paperboard, the cigarette business again is showing a lot of volume and price stability. So overall, continue to have positive bias on ITC, and though it has run up, I think the valuation when you compare it with FMCG is still very attractive. So should have a positive bias.
All right, there you have it, a positive bias there. That's ITC that we're talking about. And by the way, we're expecting revenues have about 7%. The cigarette volumes are seen at about 13 to 14%. Hemang, thanks so much for joining in. Good to have you on board. All right, let's also get in a sense as to what our chartists make of some of these newsmakers. And Nooresh, come in on ITC.
So would be a little cautious here going into results. The stock has already moved up quite a bit over the last 1 month, 1.5 months. From 370, 390 levels, the stock has gone up all the way to 425, 430. The problem is now the trend has matured. Out here, one has to keep looking out for fresh trades only when there is a fresh high. So I would be looking at it if it can cross 435, then maybe another trade. and below 415 we could see a correction and retest of 390, 400. So for now the risk rewards are not great on either side to trade. It is more a reactive trade with a very extreme short-term point of view. So for a result trade, this would not be in the picture.
All right, there you have it. That's the view coming in on ITC. But let's find out what the index calls are. What is it that our chartists are advising one do this morning in terms of their positions on the Nifty as well as on the Nifty Bank? Well, it's a unanimous call. Hold is a recommendation coming in. We were just talking about now perhaps the fact that we could likely consolidate around that 18,000 mark, and that's the consensus call, 18,300. Okay, the Nifty Bank then, it's a buy on dips. That's what Nooresh advises. Hold according to Kunal. All right, there you have it, a whole host of stocks that we will be keeping on our radar in today's trading session. In the meantime then, Kunal, let's get in your outlook as to what the view is on some of those diagnostic stocks. We were just discussing them, how they've come up from their peak COVID valuations. What's the outlook on the charts?
You know, things are a lot more better for these diagnostic stocks, at least over the recent charts, because then there are few names like Lalpath Labs, Metropolis, which have over the last 1 week, 1 month, recovered I think 8 to 10%. Now, Laurus Labs is the other name which I think is also very intriguing, because the stock was beaten down from those 700 odd levels to I think at 1.300 odd mark or sub 300 levels. But even that stock has seen some bit of consistency. So what's actually happening is that the selling has stopped for these names. These stocks are going through their own sideways ranges. Many of these stocks are coming back closer to their 200 moving averages. Some of them are still quite some distance away. But then the fact that these stocks are going through a time-wise correction, the averages are the long-term averages are nearing back for these stocks. There could probably be an indication that maybe the trend could reverse for these names. We'll wait out for a confirmation of a follow-through breakout for the diagnostic names. But I think the chart setup so far is not as bearish as what was maybe in the entire 2022 or in the second half of 2021. So I think that could be one of the positive aspects for these diagnostic names, that at least the selling is not as strong and as consistent as what was maybe last year.
Okay, 2 minutes to go. And what are we working with? We are working with the Nifty, which is flat, Sensex, which is flat, small and mid cap stocks which are not going anywhere. So we frankly don't have anything large or big in terms of the market setting. If we consolidate, there is nothing wrong with it. We should consolidate at the current level. That is just my limited point right now. I'm going to get a strategy on the Bank Nifty from Nooresh once again. Nooresh, when new highs are made, they are made with a lot of gusto. But last 2 days, the new high has not seen any kind of an accompanying follow-up.
So this has been the trend of the market. It's been slow and steady all through this move. And it's normal to do that. We are still not in a raging bull market. We are still in that period of time where we consolidate. We topped out in, say, end of 21 for the whole world. And now we are slowly getting back to the highs. There should be a pause around the previous highs. Gaining of strength before the next trend plays out. So for now, the view is the same. It's a slow and steady move, and slower and steadier better. We get into a much bigger move once we get into, say, a global rally. As of now, it's not global. It's been, say, Nikkei has gone up, European markets have, but US markets continue to struggle. So for now, the view is we will remain steady all across the indices for now. So be stock specific rather than index specific.
59 seconds to go, and the first rates will just start coming up on your screen. It's just been a yes and a no kind of nifty move, but frankly, the underlying fabric of the market is centered around FIs coming back, inflation peaking out, currency is stable, and HNI and the retail investors are just about getting excited about participating again. So the setup, I think, is intact. The pillars which have really fueled the summer 2023 rally, I think they're intact. And for me, that is important. You may just the twist and turn and moan and groan for next couple of days, but that does not change my view, at least in the near term. I think we're talking about a new high on the bank Nifty. Technically, new high was made. We reached there again, and on the Nifty we are not really far away. I mean, Reliance and HDFC Bank, if they do a little bit of support here and there, I guess markets will make a new high. First rates Wednesday morning, and it will just come up any second now. Any second the first rates will just start coming up on your screen now. 13 points high for Nifty. The market breadth not that powerful like what you were hoping for, but it is nice and steady. Newsmakers now, not too many newsmakers, but the one which, I mean, it's an odd one out, which one I want to start with, that is IOC, because numbers were quite decent. Then you want to look at Tata Motors, where that stock has moved. Post numbers it went up, yesterday it came down. Jubilant Foodworks, high beta stock, tends to react to numbers, same store sales, that's the number which everybody looks with a magnifying glass. Let's look at that one again in terms of where the setup is. Jubilant Food is rising ahead of numbers. Keynes India came out with good set of numbers. The management will be joining us a little later. And there you go. When you deliver in this market, the markets would say thank you very much. 1080, it's a brand new high for Keynes India. Bharti, yes, no, numbers were ordinary quarter, but in ordinary quarter for a stock which has been an ordinary mover this year, I guess the result reaction is constructive. But Aisha, it's the green and red. It's a combination of large cap down, mid cap up.
Yeah, can't really see a direction at least come by for the Nifty, but who knows? Let's see. It's typically the latter half when the markets really make a decisive move. After DLF's performance, there's Oberoi Realty as well. The EBITDA has come in higher by nearly about 5% in the quarter gone by. Net profit has come in at 480 crore rupees versus a comparable of 232. Still, Oberoi Realty is down 3.5%. A large part of the move in realty names already happened after DLF's earnings. That's on Monday. There's also Amber Enterprises. EBITDA has shot up 62%. Margin expansion of 30 basis points. LIC Housing Finance, we're going to be chatting with the management as well. Profit NI, both have managed to post a beat. The NIMs have come in at 2.9% versus 2.65. There's JK Paper also, which came out with its numbers. Credit Access Grameen, CCL Products, Talbros, Triveni Turbine. These are all a positive set of earnings reactions. And you are seeing a decent move come in on some of these. BPCL, by the way, the board has now approved a capex plan worth about 51,881 crore rupees. BPCL shoots up 1.25% as we speak right now. Now to the result disappointments, and unfortunately there are many at that. Nikunj highlighted Bharti. There's also JSPL, wherein the numbers are largely below the estimates and the sales volumes have seen a downtick of about 2% on a year-on-year basis. Jindal Steel starts off lower by 2.5%. Metropolis Health, we're going to be chatting with the management later on in the show. Profits are down nearly 7%. Margins have come in flat. For Paris Defense as well, the EBITDA downtick of 2.5%. Margins have slipped 240 basis points. Redington, VMart, these are all stocks or other companies which have posted a disappointing set of numbers. But let's just revisit and see where the Nifty has settled in at, and fairly quiet, just about trotting around that 18,300 level on the Nifty futures. And even the market breadth within the F&O universe at least is pretty much even Steven. Kunal, difficult to pick out stocks to trade in this market?
Yeah, difficult to pick out stocks, and I think it makes sense to stick to maybe mid-cap names or the ones which are riding on momentum. Doesn't make sense to go for a contra buy into these kind of markets, specifically for large cap names. So I think in that aspect, would stick to the performers. ICICI Bank has been one of the performing stock from the banking name, a lot more consistent, and that's a stock which I would continue to look to buy, specifically if it dips, say, comes back towards 940, 945 mark.
All right, so sticking to the large cap marquee names, is that a strategy, Nooresh, that you're taking as well?
Continuing to stick the stocks which are breaking out and look good. So Coal India has broken out yesterday. Would expect it to go further. So adding a little bit more here, looking a move towards 260 in the short term.
From Nooresh, the first rates from Kunal.